Welcome to the Wealth Studying Podcast. This is episode 498. Today is October 28th, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, all you read in the headlines is the fear that the AI bubble was about to pop and that there's going to be a recession any moment because the jobs market is collapsing. And yet that's not the story you see when you look at the scoreboard, because the stock market keeps going up, as does U.S. GDP. Well, how can that be happening? Well, as always, it's the tale of two cities. People like to talk about the bifurcated economy. There's always a bifurcated economy. The so-called K recovery right now, where there's a wealth effect and it's favoring the upper income groups as opposed to lower and middle class. Well, here, put your ear up real close to the speaker. I got a secret I want to tell you. Life is always better for the rich. That's the truth. I promise you. I've been rich, I've been poor. Rich is much better. And is no different today than it's ever been. So put the negativity aside. Let's focus on some things that's driving this economy. And if you're not already thinking in this direction, maybe it'll help you for next year. Okay, number one, is there an AI bubble? Listen, I'm as skeptical and cynical as anybody else when it comes from hype coming out of Wall Street. Going back, 2022-ish, I totally didn't believe the NVIDIA numbers. I never thought the growth could keep up. But you know what? My opinion changes when the facts in evidence support the narrative. And the AI spending is not only real, but it's also being distributed throughout the economy, and it's helping overall productivity. That's indisputable. Now, it doesn't mean that there isn't a lot of hype out there, and there's, many people are going to be disappointed with focusing and emphasizing on too narrow of a niche for their investments. But overall, the impact of artificial intelligence and the broader picture of robotics and automation are here and now, and they're drastically improving productivity, and it really should come as no surprise to you. In fact, it's almost a decade ago that I wrote a book about it. And while all kinds of comparisons want to be made to the dot-com bubble, I can tell you, I was there during the dot-com bubble, and this is the same but different. The big difference being that companies on both sides of the trade on AI are profitable. People selling AI products and services are making money, and people buying and using AI products and services are making money. It's a big difference from what we saw in the run-up to the dot-com bubble. Now, again, not to say that this isn't cyclical. Go look at semiconductor chips in general. Their industry is categorized as what? A cyclical industry. Just like virtually any other industry, that's why we call it a business cycle. But right now, the AI and automation and robotics industries are firing on all cylinders. As far as recessionary fears, now a lot of that's coming from fear of tariffs and also what's perceived as a sluggish job market. Well, again, I would just tell you, look at the scorecard. Look at the GDP numbers. First quarter GDP came in very low. I would argue that that was more of a modeling issue where the, garbage in, garbage out kind of played out there, because there was such a pull through where people were trying to get I'm talking about exporters from other countries, were trying to get product into the United States fast and ahead of the Liberation Day tariffs. So that skewed the numbers, and the economists should have taken that into account, but they didn't. And so we ended up with a negative 0.6% GDP growth, which again, I think is phony baloney. But look what's happened in the two succeeding quarters. Second quarter GDP growth came in at 3.8%. I'll repeat that for you. 3.8%. Oh, was that just a fluke? Well, right now, third quarter GDP estimates are at 3.9%. Now, there's still a lot of negative Nelly economists out there, which are predicting much less than 2% GDP growth for the year. A lot of them on a consensus of around 1.7, 1.75% GDP growth. Well, for that to happen, that means that fourth quarter GDP would have to be negative, something like negative 0.3% growth for fourth quarter. I doubt that's going to happen, so that means this year is going to come in above 2%. In fact, as long as GDP growth for fourth quarter is at least 1%, then we'll come in for the full year, even with the big drawdown during first quarter. That'll mean that 2025 will still be above 2% growth, could be significantly above that depending upon how well the fourth quarter goes. And while you may say, well, 2% GDP growth isn't that big of a deal, yes, it is. Pull up a long-term chart. Anything above 2% GDP growth moves the needle in the right direction. And while it's nothing to necessarily brag about, when you consider the major, and I'm talking seismic shifts we've had in the global economy, primarily because of tariffs and other industrial policies that have been enacted this year, for all that to happen and for the U.S. to still be experiencing a 2% or better growth rate during this transition, well, it's nothing short of phenomenal. But that is what the scorecard is telling us. And it's also reflected in corporate profits, and that's exactly why the stock market is doing so well. Corporate profits are coordinating right along with GDP. In fact, they're better. First quarter profits came in at something like 12.8%. Now, the skeptics said we could never match that again. They'd at least be cut in half. I actually thought that was likely over the summer, and that's why I was thinking we might see a pullback. Not that a 6% growth rate over the summer would have been horrible, because that's still pretty good with corporate profits when you consider how long they've been in double digits since we've come out of the pandemic. But I still thought that there could be a cooling process, especially as the dreaded tariffs and industrial policy work their way through, the python belly of the economy. Well, guess what? Second quarter came in pretty much just as strong. I think it was over 12%, at least well into the 11% corporate profit growth rate. And, the negative Nellies are back at it. They say, well, third quarter won't be as good. Well, they're still saying it's going to be 8 to 9%. There's a lot of people that still think it could be double digits. Either way, we're still looking at solid corporate profit growth. That's what's driving the stock market higher, in spite of all the negativity. And the reason all this is happening is because the economy is dynamic and resilient. Consumer spending is holding up. And again, this was against all the naysayers talking about how, there's a K-shaped recovery and lower income workers are struggling. And again, that's nothing new. And if you want to see disparity, which people love to talk so much about in our country, go look outside the country. Take a look at China if you want to see real wealth disparity. In any case, the numbers hold up that consumer spending is doing just fine. And here's why. People spend, right? It's part of our society. It's what makes the economy. And people that have a lot of wealth proportionally don't spend more. That's why they're wealthy, is because they keep a great deal of what they have. But their spending in aggregate is so large, that's what always drives the economy. And so you shouldn't dwell on the fact that lower income people are having a harder time and have less to spend. If you're investing, or if you're, planning your career, then you should be investing in things that wealthy people are spending their money on, because those are the companies that are going to have the most profits. Likewise with your career. Yeah, if you serve lower income people, you're likely going to have a lower income as well. So focus on the upper end, right? Why did Jesse James rob banks? Because that's where the money is. Same thing with wealthy people. There were so many people post-pandemic that were worried about a collapse in the real estate market. And I was never worried about real estate in terms of single property residential real estate. Because again, if you look at the numbers, despite all the bad headlines, there's a housing shortage. We don't have enough single-family real estate. Now, I'm not going to be investing in brick and mortar retail, or I don't want to invest in office space in the cities because I think that's still sketchy. But when it comes to residential single properties, I'm all about that. And that's why, a couple years ago, I bought into Toll Brothers. They're a publicly traded stock that focuses on the upper income consumer. And it's just an example of what I'm talking about. Listen, you can invest in a lot of home builders, but why not focus on the cream of the crop? Because those people are always going to have money to buy one way or the other. And yes, there's business cycles in home building just like in anything else. But if you're owning the best, if you're owning the blue chips, they're going to weather the storms the best. But overall, even on the non-wealthy side of consumer spending, it still holds up because people simply have to consume to exist. And if you're someone that's, say, in the lower end of the middle income group and you can't afford a house, or maybe you can't even afford a new car at the crazy prices we're seeing right now. And listen, I'm not disputing that prices are overinflated. They just are, but that's the reality of the situation. That's also what drives corporate profits. Remember, profits are a derivative of the sales price. And if inflation keeps making the sales price go up, and if you hold your margins constant, then you're going to consistently make more money. Again, something to think about with how you form your investments and the career field you go into. Don't get stuck into fixed income, whether it's investing or whether it's a career choice. But back to consumer spending. Okay, let's say you can't afford a house or you can't afford a new car. Well, you still have money and you still want to have an indulgence. So you buy a used car. Or if you can't afford that house, you still want to make your life a little bit better. So you buy something to fix up your apartment. Or you take yourself out to dinner to make yourself feel better. There's plenty of people that can't afford a house that are buying double frappuccinos. Now, I got to step back a second. I don't even know what the heck a frappuccino is, let alone a double frappuccino. But as I dig down and look at the data, that's what I'm seeing. I'm seeing that people are still spending money. And as far as all the inflation fears, well, a lot of inflation is coming down. It has to do with core inflation. Take a look at the gas pump. Oil prices are coming down. That's actually having more of a deflationary impact than tariffs are having an inflationary impact. Because tariffs only affect about 10, 11% of the economy, which is based on imports, where virtually the entire economy has to buy some form of petroleum. We're also seeing the biggest impact of price increases, not on goods, which you would think would be impacted by tariffs, but actually it's on services. And I think that has to do with what I was talking about with consumers wanting to spend. Maybe you can't buy that new car, but you can still afford a massage, or you can afford to get your nails done, or your hair cut. And those service sectors know you have the money, so they keep raising the price. It's the bottom line. And that slowing job market where everybody's so worried about, well, remember, the jobs numbers were inflated coming out of the pandemic because so many baby boomers and so many caregivers left the job market abruptly and never returned, or came back at a very slow rate. So the retirements that we anticipated from the baby boomers were pulled forward. That caused a huge increase in the cost of labor. Well, now that's cooling down. And again, just like lower oil prices, that's good for the overall economy. Well, at least good for corporate profits, which is what we're investing in. If you're listening to this podcast, we're interested in investing because we want to own companies that have growing profits. And how do you have growing profits if you're a company? You do that by increasing productivity. And that's been a hard thing to do post-pandemic with the huge increase in labor costs. Well, it's finally starting to subside. Moderating labor costs will have a bigger overall impact on inflation than tariffs will. You know what else is totally holding up this economy beyond consumer spending? And that's industrial spending. The amount of investment that's occurring in the United States, whether it's domestic companies reinvesting in their businesses or whether it's foreign capital, it's immense. It's something that we really haven't seen for multiple generations. Some of it's based on the whole AI boom and the need for data centers, but a lot of it is just the shift in geopolitical landscapes, that I've been talking about for multiple years now. Listen, we may not be in Cold War II, but we are definitely in an economic warfare, and that means the industrial policy of this country has literally changed and is changing like we haven't seen in 80 years. That means more industrial domestic spending and growth. And again, this isn't Pollyanna pie in the sky stuff. Just look at the numbers. Look at the trends of industrial construction for decades prior to the pandemic. This country was spending, 50, 60 billion maybe a year building new factories and upgrading existing factories. Today, not counting data centers, but I'm talking about industrial construction, building factories that build other things, that spending is running like well over 3.5, in many cases 4 times what we were spending for 20 or 30 years of the trend before the pandemic. And that's not slowing down anytime soon because we are on an economic war footing. And this is why you've heard me for quite a while now talking about the convergence of not only technology, but industrialization. And you know what? As good as it's been this year, I think it potentially could be better next year. And I know that sounds like crazy talk, but think about it. These productivity improvements are getting better. They are making corporate profits go up. Just look at what Amazon announced. They're laying off something like 30,000 more positions, and this is ahead of what they've already announced. And these are just not, people packing boxes in the warehouses. They're talking about management and white collar. Why is that? Is it because they don't need the employees? Is it because their business is bad? No, it's because of productivity improvements from artificial intelligence, from robotics, from automation. These things are real and they're happening real time. And why could things get better next year? Well, again, that productivity improvement is getting better. And we also have a lot of policies that are going to really come into play next year. Deregulation is, again, a real thing. It's taking down barriers to allow us to build these factories faster. Things like mergers and acquisitions that hadn't happened in a long time, they're happening now. Just the overall reduction in paperwork. I can tell you, in my industry, just in terms of rules and regulations dealing with the SEC, there were 14 rule proposals that have been totally eliminated and taken off the table. That's just one example of how businesses can be more flexible and more profitable because they're spending time on the things that make them money and not filling out paperwork and forms on the things that don't. And what about tax incentives? Things like the 100% advanced depreciation, that's been effective this year. It's going to kick in even more over the next few years. And even a guy like me, right, a very frugal, tight-fisted spender like me, my company car has 100,000 miles on it. I could easily squeeze out more mileage, but you know what? I'm getting ready to write a check to buy a new company car this year. Why? Well, it just makes economic sense to buy it now, this year, and take the advanced depreciation. But again, that will continue into next year and beyond. And you magnify that beyond just a small business like mine, and that explains the domestic investments, both domestic money and foreign money, into building these factories because they're not only favored by industrial policy, but also by tax policy. Again, these are multi-year trends, decade trends, in fact. I already mentioned lower oil prices. We're seeing interest rates come down, which means that the cost of borrowing money comes down. We have labor costs going up at a slower rate. These are all advantages for corporate profits. Again, this is going to be for big companies as well as small. My business is thriving. And you know what? Your business or your career could be too. Take advantage of the trends. Take advantage of the opportunities. I got to tell you, I am more cynically optimistic in the upcoming year than I've been in a good decade. So there you have it. Put aside the negativity and go out and make some money. And I hope you come on back for future episodes. Until then, as always, this is John Pugliano wishing you the very best returns.